There is, as of last month, yes. So this is a REIT that I find quite interesting. It's on my watch list at the moment. It's a fairly recent addition. It became a REIT last month in September. And why I think it's interesting is this is Grainger, and not to be confused with Grainger Inc. This is Grainger PLC. So the ticker is GRI. It's the UK's largest residential landlord, and it's just gone through this strategic shift to swap from just being a PLC to a REIT. And I wanted to just take a look at why they've done that and the most recent results, and why I actually think this is quite an interesting looking company. So just to go back historically at the beginning of the year, they said, look, we're going to do this. We're going to, our book value is very low. It was 0.85% or something like that. We want to go to a REIT because we think that will close the book value up. The market said, cool, we're going to send you down like 15% over the year. And now the book value is at 0.7%, which is, again, Steve and I would urge you to use that metric when looking at a big old bunch of properties like this one. It is a good metric for that. But let's have a look at it. Let's have a look at the transition a little bit more on what they do, and we'll see if we can come to a conclusion at the end of it. Which, again, it's a conclusion that I haven't quite got to in my own head yet. So I'll be doing this one on the fly. But I like this quite a bit. We'll see together. So yes, the UK's largest residential landlord. They specialise in the build to rent sector. So when we talked about Vistry, essentially building for private people, this is an idea of somebody who Vistry might build for, although Grainger like to do quite a lot of the building themselves. They build, own, manage large-scale, high-quality, both apartment complexes and housing complexes, specifically designed for long-term professional renting in key cities across the UK. So they want, people who get drawn to, say, London, for example, is one of the good areas they've got. They built a load of houses on a load of TfL, Transport for London land, and they manage and rent those houses. I think 3,000 houses for on TfL land, and they rent them out to obviously to professional people who are commuting around London. For us investors, I guess Grainger provides probably one of the best ways to gain exposure to the UK residential rental market without the hassle of buying a buy-to-let yourself. So that's kind of the overview of what they do. They're over 100 years old, 113-year-old company, I think it was at last time. They're headquartered in Newcastle. And so as of the latest trading update, there was 4 bits of it that really jumped out to me they're interesting. So the high occupancy rate really strong for somebody who has a portfolio of houses as big as they do, 98.1%. So nearly all of their homes are rented. Obviously, that's a key measure of REIT demand, REIT operational efficiency. Grainger doing a very good job there. It was 96% the quarter before, just to give you a comparison. So that's doing pretty well. They said that they continue to see healthy rental growth across its portfolio, which aligns with their medium-term forecast. They said this is driven by a couple of things, but it's the things that you would expect: high demand, structural imbalance between the supply of rental homes and the number of people who actually want to rent in the UK. In terms of their earnings pipeline, Steve, they said they've got a fully funded development pipeline of new homes valued at £1.3 billion. The pipeline is essentially their engine for future growth. The company forecasts that they'll deliver about a 50% growth in its EPRA earnings, which is a key profit measure for property companies by the 2029 financial year. And just on EPRA, that's it stands for European Public Real Estate Association, I think, is the earning. I think that's what it stands for. But it's basically an attempt to standardize REIT earnings, and they cut out the non-cash items like things like property reevaluations and gains and losses from property sales. So it's more of a metric to give you a transparent look at the recurring income that's generated from these companies, because essentially as REIT owners, especially in this sector, that's what we want to know. There's no like hiding it through, oh, we've sold a couple of bits here and there, and we can shuffle that in the earnings, and people won't know they've actually gone down. There's no doing that with EPRA, so it's a good metric to use. Grainger has been selling off properties though. They sell off their older, lower yielding, and what they call non-core assets. This is things like regulated tenancies. And they reinvest the proceeds from this into its modern, high-yielding build-to-rent developments. They said that this process is strengthening both the quality and profitability of their portfolio, and you can see that because they're essentially giving you 50% growth in EPRA just over the next sort of few years. So that would be interesting. But September 2025, yes, they converted to a REIT. This was a fully planned, fully implemented structure change. It's a 9-year strategy that they've been going through. It's basically the culmination of this point. They wanted to simplify the business and make it into a pure play residential buy-to-rent operator. This conversion is good for Grainger and its investors. If you're an investor who's focused on getting income, it eliminates the double taxation for Grainger, so it makes it more tax efficient. Basically, the main benefit of a REIT for folks is tax transparency. So before, rental profits were going to be taxed at a corporate level on corporate tax, and then taxed again when paid out to shareholders through your income taxes or your dividend taxes. But as a REIT, Grainger is now exempt from corporation tax on the rental profits and the capital gains from its property rental business. This tax saving flows directly to you, the shareholder. To maintain this status, this tax advantage status, a REIT in the UK, same in the US, has to pay out and distribute at least 90% of its rental profits to shareholders each year as a dividend. These can be property income distributions called PIDs. PID and non-PID is how you will receive. But yes, they think that this will also help attract new capital. They said that many large international pension funds, institutional investors, they're mandated to only invest in REITs due to the income-focused structure. By converting, they think Grainger can now access this larger pool of global capital, which will help support the growth and this development pipeline. The CEO said it's championing the strategic shift. Our successful conversion to REIT status marks a significant milestone in Grainger's strategic transformation. Over the past 9 years, we have fundamentally reshaped our business to become the UK's leading build-to-rent provider. This conversion enhances our ability to deliver sustainable returns to shareholders while continuing to provide high-quality rental homes for our customers. I think it's a pretty simple-looking business now, Steve. If they were looking to simplify, they've done a really good job of that, I would argue. So I think that's particularly interesting. A few closing thoughts, I guess, before I pass back to you, Steve. But I think they've managed to clear the focus somewhat on their business. So it was a little bit convoluted beforehand. This high quality professional rental homes in the UK in specific target cities makes it very easy to understand what's going on here. The switch to the REIT status with the mandatory profit distribution, it becomes attractive for people looking for dividend income and also that growth trajectory, Steve, from the pre-funded development pipeline with the 50% growth in the earnings as well. Expansion of the portfolio. It looks pretty interesting to me. Just to reiterate, this company is worth 1.43 billion in market cap. They're planning on building 1.6 billion of new houses to their portfolio. So there's going to be some stuff shipped off the back of that still. But you're going to look at a reasonable expansion of portfolio here. Probably a doubling, maybe just under a doubling of portfolio here. I think it looks really interesting here, Steve. I would, the balance sheet needs a little bit of work still. There's about around the sort of 1.6 billion-ish of debt at the moment. That has come down a little bit in the last quarter. That's something that they're actively working on. But largely, Steve, I think this is a very interesting company right here. I think the the move over to a REIT to be, that people are saying this is for income investors. I think that's a little bit of a misnomer, Steve, with this paying a 4.08% dividend. That's not huge in the REIT sector. And I would say that the reason that it's not huge is because there's this huge amount of growth still to come into that. So I think the dividend of today is very different to what the dividend of tomorrow is going to be. And I think this is in a very interesting position at the moment, Steve. What do you think?
It's the kind of company I'd love to have bought 10 years ago when I was just starting to think about sort of investing. And if you ever kind of had this idea that you wanted to just rent out a bunch of properties, but didn't really want to kind of find them and manage them and pay the associated taxes, which are now even higher than they would have been 10 years ago. But it felt like everyone was basically making money in the property sector. This kind of feels like the most straightforward way to do it if you don't really have much of a view about industrial distribution properties or the future outlook for supermarkets or the competitive landscape around data centers or whatever. Pretty much everyone understands UK housing that lives in the UK one way or another. We haven't got enough of it, and for reasons that you and I were discussing off air last week, building enough of it, whichever way you look at it, has been a struggle for one government after another. Party politics aside here for the time being, successive governments have said, we're going to build more houses, and they found it's harder than it turns out. It's much, much easier said than done, building more houses. And if you think that's likely to continue, and I wouldn't necessarily argue, you will think this is another case of constrained supply here, and that the assets Grainger has should do pretty well going forward. You mentioned 98.1% occupancy ratio. That's because some of their stuff is pretty new. It looks like they haven't managed to get around to leasing it yet, but oh well, I imagine that's on the way. This looks like a really, really nice business, at least from that regard. If I had bought the thing 10 years ago, it would have been a bloody disaster. Well, no, it wouldn't have been a disaster. I'd have done not amazingly well. It looks to me like the stock price is slightly lower than it was a decade ago. And that's been the case as they've struggled to get their share price to reflect their book value. Well, that may be on the way with a bit of REIT transition support here. Investors, I guess, yeah, we say not for income investors per se. It's a slightly odd one. The PRS REIT, which is much, much smaller, but we have talked about on the show before, currently trades with a dividend yield just below 4%, so slightly less than Grainger, but also in that kind of ballpark of not your 7, 8, 9% yields that we've been seeing in some parts of the UK REIT sphere recently. I sort of think I quite like this a lot. I feel like it's getting harder and harder to lease things, but I think people with existing properties are in a much better position than people trying to get into this space. Grainger, yeah, it stands out to me almost kind of emotionally in certain ways. I sort of like the idea of leasing a load of properties. I can see that they do indeed focus on major cities, so nothing whatsoever in Hull, because obviously demand there is so strong that there's nothing on the market. And stuff doesn't stick to the shelves in Hull. It all just goes immediately. They got a couple of things in Oxford which look to be quite nicely positioned. A couple of things in Sheffield which I think also look quite nicely positioned. Other big cities they have include Bury, of course, another major area, Newbury, which is, I think the reason that counts as a major place is because it's where all the blooming telcos have their headquarters. Not that anyone should be massively excited about being near Vodafone HQ. But yeah, I like this quite a bit. Steve, I think they have an interesting plan. It's always interesting when REITs have strategies for growth and building basically their market cap in terms of additional capacity. Well, if they can find ways to do it, and it looks like they can, hard to see how there won't be demand for it, Steve.
Yeah, absolutely, Steve. You can tell the demand's there because they've been able to push through like-for-like rental growth of about 3.6%, which is pretty decent year over year. It's probably just about above inflation. So when that's happening across a portfolio of about 11,000 homes, they've done pretty well, Steve. I'm pretty interested to see how this one goes from here. 169 million generated from disposals in the last year as well, Steve. So they're still doing work on this portfolio, but I think this portfolio gets better and better over time. And I think I'm all for stripping out the low quality homes and selling them off and focusing on high quality. That's a strategy that's obviously working for them. And yeah, this one's been on the watch list for a couple of probably for a month or so. I just didn't know if there was enough interesting stuff for it to be a feature on the show, but it's come down quite a bit, Steve, and it continues to just sort of drag on this year. It was in the 220s. It's fell nearly 12.5% since I've added it to my watch list, and it starts to look rather attractive really quickly. I think the market's been slow to catch on to this transition, Steve, and I think we're at the end of the sort of structural shift and the simplification of the business and this move to REIT status. And I'm pretty interested here, Steve. I think this might be the thing we look back 10 years ago and say, maybe we wish we bought it here. But yeah, it's definitely one that I'm going to consider a little bit more. And yeah, it's just whether I can stomach having Vistry, Taylor Wimpey, and Grainger all in the sort of very similar kind of space to each other, and whether that overexposes me a little bit. But maybe.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.